Today on Go Ahead Ask, did you know that you can invest your self-directed IRA in real estate related assets such as deeds of trust, mortgages, tax lien certificates, real property, limited partnerships, and other alternative investments instead of stocks, bonds, and mutual funds? Let's unravel that today on Go Ahead Ask.
Building wealth in real estate? Let the Exeter Group take the mystery out of how it's done on Go Ahead Ask.
Welcome to the Go Ahead Ask podcast by the Exeter Group, where we unravel the mystery of investment real estate to provide investors with better quality information so that you can make better informed investment decisions. First, Happy New Year. I hope you all had a really healthy, safe, and happy New Year's celebration. We're looking forward to a much better 2021, or as we call it, a happier new year. I'm Bill Exeter, the CEO of Exeter Trust Company, and will be your host today. The Exeter Group of Companies includes Exeter 1031 Exchange Services, which serves as a qualified intermediary for 1031 exchange transactions. We administer all types of 1031 exchange transactions in all 50 states. It also includes Exeter Trust Company. Exeter Trust Company serves as custodian for self-directed IRAs and individual 401ks, which is the topic of today's podcast. It serves as trustee for title holding trusts or land trusts. It serves as escrow agent for specialty holding escrows and serves as custodian for various custody services and custody accounts. I'd go ahead and ask, we encourage questions. So please send your questions or even topics you'd like us to cover to ask@exeterco.com, or you can call us at area code 619-239-3091. If you love our podcast, please like it, subscribe to it, and share it with friends and family. Today, our podcast is entitled Unraveling the Mystery of Self-Directed IRAs, an Introduction. Our goal today is to introduce you to the topic of self-directed IRAs. We've had many listeners and clients who've emailed in asking about self-directed IRAs and how they work. So today we're going to unravel the mystery of self-directed IRAs. The first thing to remember is all IRAs are self-directed IRAs. That sounds like an interesting comment, but you as an investor choose where to put your self-directed IRA. You may choose to deposit it at a commercial bank and have a money market account or a certificate of deposit. You may choose to put it at a securities firm and buy stocks and bonds and mutual funds. Or you may choose to deposit the IRA with a trust company and then have various other options for investment choices. The real issue there is that they're all self-directed IRAs, so you need to decide what you want to invest in, and then once you've made that decision, then you decide what you're going to invest in through what company, whether it be a trust company, a securities firm, or a commercial bank. There are all sorts of traditional IRAs. There's rollover IRAs, inherited IRAs, Roth IRAs, Roth conversion IRAs, SEP IRAs, and simple IRAs, as well as individual 401ks, are often referred to as solo Ks. All of these can be structured as self-directed accounts where you choose what you want to invest in. So again, the real issue is choosing the IRA custodian or the 401k custodian that can allow you to invest in the types of assets that you want to invest in. Traditional IRA custodians generally limit you to what they offer. So banks, of course, limit you to the deposit accounts they have, like money market accounts, certificates of deposit. Some of them have a securities division where you can buy stocks and bonds and mutual funds. If you go with a securities firm, they're going to limit you to publicly traded assets. Again, stocks, bonds, and mutual funds. They're not set up to offer what we refer to as alternative assets or non-traditional assets. If you roll your IRA or transfer your IRA over to a trust company, some trust companies truly allow a much broader range of investment choices or investment options. So if you get into what we call a real or true self-directed IRA, your IRA can actually invest in, which means you're buying these investments or these assets inside of your IRA account. And those investments can include things like real estate, deeds of trust, mortgage loans, promissory notes, tax lien certificates, limited partnerships, limited liability companies, private equity, private companies, and much, much more. So there's lots of options that you can actually look at investing your IRA funds in, depending on what you're comfortable with and what you really want to focus on. Some people are really good with stocks and bonds and mutual funds, and that's their focus. Some people are really good or really understand real estate, and that's their focus. So you have to decide what you are comfortable with and what you want your preference to be. Once you decide what you want to do, what types of assets you want to invest in, then you have to choose the right IRA custodian for you, and an IRA custodian that will allow you to buy and invest in the type of assets you want to focus on. So generally that means if you're going to focus on real estate, you probably have your current IRA at a different company like a bank or like a securities firm, and you probably need to transfer that over to a trust company that will allow that, like Exeter Trust Company. So one of the things we allow is all sorts of real estate related assets inside the IRA. So the first step then is you've made your choice. You want to invest in real estate related assets or some other type of alternative investment. Now you're ready to choose your IRA custodian, and you talk to us, you choose Exeter Trust Company. And the next step after that is to transfer your IRA from the current custodian to us as the new custodian. So it's still the same self-directed IRA, except now you have a brand new IRA custodian that allows you to invest in a much broader range of choices, many of which are non-traditional or alternative investments like real estate related assets. So how do we transfer the account? There's a number of ways of doing that. I want to spend a little more time on this one because it's important. There's a couple different ways to do it. One is called an IRA to IRA transfer or custodian to custodian transfer. And that literally means that your funds in your current IRA account or your current assets or investments in the account are transferred directly to Exeter Trust Company as your new IRA custodian. So that's an IRA to IRA transfer. You can do as many of those as you want. There's no limit on how many IRA to IRA transfers you can accomplish. And because it's between two different IRA custodians, there is no tax reporting involved. So that eliminates any reporting to the IRS or your state. It also eliminates or reduces the possibility of human error since there's no reporting required. And there's unlimited numbers that you can do. So that's the benefit of the IRA to IRA custodian transfer. So you always want to try to do an IRA to IRA transfer. Now, the second type of transfer is an IRA rollover. Now, with an IRA rollover, in that case, generally the current IRA custodian is distributing the funds to you as the client. That's a reportable event. That's a taxable event. It's reported on a 1099-R that you've received a distribution out of your current IRA account. You then forward the funds to us within 60 days. It's a 60-day rollover period. And then we're going to book it as a rollover contribution, which is also reported to the IRS as a rollover contribution. You have a distribution and a rollover that equals zero. So that cancels out your tax consequence. However, there's a number of issues with an IRA rollover. Number one, you're only allowed one per year. Doesn't matter how many IRA accounts you have, you're only allowed one IRA rollover per year. Two, it is reportable both by the IRA company, IRA custodian that's distributing the funds to you, and by the receiving IRA custodian. So there's always that chance there could be some kind of an error in the tax reporting. And anytime we eliminate the ability to do a tax reporting event, it's always a better thing. Why would we use an IRA rollover? The IRA rollover to me is really reserved for an emergency situation. If you have an opportunity to make some type of an investment. Say you're making a mortgage loan, you're making a deed of trust, you're going to buy real estate, and you don't have time to wait for the IRA to IRA custodian, that's a transfer. That may be when you want to actually do the IRA rollover. You can run down to your current custodian, get a check, deposit it in your checking account, immediately write a check, run over to the new custodian and deposit it into your new IRA with the new custodian. So that speeds up the process, but you're only allowed one of those per year. So you almost always want to do the IRA to IRA transfer. That way you have unlimited numbers. There's no reporting requirement. It's much simpler, much more straightforward, and less chance of error. Reserve the IRA rollover for when things go wrong and you have an emergency situation. If you're moving funds from a retirement account, such as a pension, a 401k, a 403b, etc., those are going to be done generally like a direct rollover. So it's coming directly from the trustee of your pension or 401k or 403b and rolled over directly to your new IRA custodian. So you're going from a pension or 401k profit sharing plan to a self-directed IRA. So those are also allowed when there's some type of a pension or profit sharing plan involved. The final way to get money into the new IRA too, of course, is making an IRA contribution. The challenge with self-directed IRAs is usually you need more than your annual IRA contribution to make the investment you're looking at. So generally it's going to be an IRA to IRA transfer from another IRA account. So you have a much larger balance in order to make the investments that you're looking to do. Then we get a lot of questions about what are the permissible investments? What can my IRA invest in? And it's a very broad list. In fact, it's probably better to ask what you can't invest in, because that's a much shorter list. So the things you cannot invest in through a self-directed IRA would be S corporation. So you can't have your IRA buy stock in a subchapter S corporation. You can't have your IRA buy life insurance contracts. And you can't have your IRA buy any type of collectibles, such as artwork, coins, collectible cars, antiques, gems, stamps, rugs, things like that are not permissible. But those investments that are permissible is really everything else. So the more common types that at least we get involved with at Exeter Trust Company is real estate related assets. It's one of the benefits of Exeter Trust Company is that we have people on staff that have an expertise not just in self-directed IRAs and in trust company operations, but we have a lot of people who have a very detailed expertise and experience in real estate. So we understand how to buy and sell real estate. We understand how to go through the closing process, to work with an escrow company, a title company, a closing attorney, etc. So that's what really sets us apart, is the ability to understand not only the IRA, the trust company, but also the real estate component that you're looking to do. So the permissible investments generally include things like real estate, a promissory note secured by a deed of trust, often just referred to as a deed of trust, a promissory note secured by a mortgage, often referred just to as a mortgage. You could do unsecured loans, although you have to be careful with unsecured loans. A lot of times they don't get paid back, but you can do unsecured loans. You could buy tax lien certificates, limited partnership interests, limited liability company interests, private equity, private corporations. You can get into things like Bitcoin and other digital currencies. There's all sorts of things you can probably invest in, but you need to decide what you're comfortable with, what your expertise is, and what you are comfortable with. That's what it boils down to, because you're self-directing this account. You have the discretionary authority to choose the investment. So it's got to be something that you're comfortable with. Once you've decided, what you're going to invest in, you transfer your IRA over to Exeter Trust Company. Now you're ready to make your investment. You've chosen, let's say, it's some type of real estate that you want to get involved with. We actually go through the process and have your IRA buy the real estate investment that you choose. The next step is every year the ERISA code, which is a federal code, requires that the assets held in your IRA be valued. And so that's one of the challenges with self-directed IRAs, is you have to be able to value the asset every particular year. That doesn't mean you have to go out and hire an appraiser or things like that. You can have a broker give you a written BPO, broker price opinion, if it's a real property asset. If it's a mortgage or deed of trust, generally it's just valued at the face amount of the note. So it may be just a third party who gives you a written opinion as to what the value is. And you could support that with all sorts of research you can do on the internet. If you buy into private equity, private companies, etc., whoever handles that particular company, administers that company, can probably give you some type of evaluation of what they think it's worth and put that in writing and provide it to the IRA custodian. So you have to keep that in mind and think about how you're going to have the asset valued every year to make it easy for the IRA custodian to do its job in reporting to the IRS.
Today's episode is sponsored by Realized 1031. Realized helps clients in their 1031 exchange by using DSTs to build turnkey, diversified, tax-efficient portfolios of professionally managed, commercial-grade properties, all designed to help you meet your investment goals. To learn more, visit www.realized1031.com. Securities offered on this website are offered exclusively through Thornhill Securities, Inc., a registered broker-dealer and member of FINRA SIPC.
The other thing you have to be careful with in self-directed IRAs is something called a prohibited transaction. There are certain things you cannot do with your self-directed IRA. If you do some of these things that I'll discuss, it's called a prohibited transaction and could result in either the amount you invested or the entire IRA as disqualified and therefore taxable. So prohibited transactions are not good. You want to avoid them at all cost. So you just need to be aware of them. And generally, a prohibited transaction involves self-dealing. You can't borrow money from your own IRA. You can't go to a bank and get a loan and pledge your IRA as collateral. You can't buy or sell an asset in the IRA for personal use. You can't buy real estate for you to live in. You can't lend money to your parents or your grandparents or your kids or grandkids, etc. Those are self-dealing transactions and considered prohibited. So that kind of gives you a quick overview. We'll have another podcast episode devoted just to certain topics we've given an overview of today. We just want you to be aware of prohibited transactions. You have to be very careful that you don't use your IRA for personal benefit or personal gain. When you're thinking along those lines, it really boils down to a disqualified party. So when I mention you can't loan to a family member, things like that, disqualified parties are going to be your parents, your grandparents, your great-grandparents, etc., your ancestors. It's going to be your lineal descendants, your kids, your grandkids, your great-grandkids, etc. Your spouse is going to be considered a related party and a disqualified party. And you can't do business with the IRA custodian or the IRA trustee. Those are all disqualified parties. So our job is to kind of help you identify those issues. And as you're going through your investments, we'll try to point those out to you. But we just want to make sure that you're aware of that. So let's talk about the parties to a self-directed IRA real quickly. So the first party and the most important party, of course, is you as the investor or taxpayer. You're the IRA owner. You set up the IRA. You choose what to invest in. You choose what entity to put your self-directed IRA at. Then you're going to name one or more beneficiaries to your IRA. And the beneficiaries are those who get the asset, get the IRA account once you pass on. So it's important to always name a beneficiary. There's lots of strategies behind naming beneficiaries, so be very careful with that. Talk to your attorneys, your accountant, and your financial advisors to make sure you've named the beneficiaries in the proper manner and the proper person, of course. The third party will be your IRA custodian, and that would be Exeter Trust Company. So we actually act as the IRA custodian and help administer your account. It's completely self-directed. You choose what to invest in. We just process the transaction. You may also have an investment manager or an investment advisor, a real estate agent or broker. You might have a mortgage broker that you're working with. A lot of investors will work with a hard money mortgage broker and help invest or help fund those hard money loans that they make. You might have a property manager. It's very important that the investments you choose inside of the IRA are passive investments. You're not allowed to actually go out and work it. So if you buy real estate, generally the safest way is to hire a property manager that can do all the work, manage the property, collect the rents, etc., so that it's not considered an active investment. Active investment can cause all sorts of issues. We'll touch upon that quickly. And you should have a legal, tax, and financial advisor to help you go through your decision-making processes. The next step is remember, it's very important to remember and keep in mind that you are not the IRA. You do not own these investments. Your IRA owns the investments. The IRA is a completely separate entity from you as a person. That's why the IRA has to have an IRA custodian. So Exeter Trust Company, as the IRA custodian, holds title to all the assets you choose and administers them based on your instructions. So all of the assets you invest in would be titled under Exeter Trust Company as custodian of IRA number 123456 for the benefit of John Smith. It's extremely important that they're properly titled. I can't tell you how many times I've seen somebody buy real estate and the title ends up with something like John Smith IRA. That legally does not exist. There is no legal entity called John Smith IRA, and that creates all sorts of problems for your legal title to real estate going forward. Probably will involve a kind of some type of a court action, a quiet title action where you have to clean up title. So it's very important that you get the title correctly. And remember that you're not making the investment, your IRA is making the investment. There should not be any personal benefit to those investments that you do. And you have to make sure that the IRAs, or the IRA that you are using and rolling over and investing in real estate related assets, makes sense from a tax perspective. So have your CPA review the investments and decide, is real estate the right investment inside of your IRA? Or would it be better to have the real estate outside of the IRA in your individual name perhaps, and then inside the IRA might be deeds of trust, mortgages, tax lien certificates, which produce ordinary income. So there's lots of tax strategies that can go into that, and we'll have a podcast episode just on that as well. So, but also remember that anything you invest in inside of your IRA is an IRA asset. So going forward, any revenue or income or cash flow generated by that investment has to go back to the IRA. If you collect rents, if you collect a mortgage payment, and you personally deposit that in your checking account, that is a prohibited transaction. So all of the income, all the revenue, all the income has to go back into the self-directed IRA. The same goes for expenses. Any expenses involved with administering that investment has to come out of your self-directed IRA. So if you decide to buy rental property inside the self-directed IRA, and maybe the tenant moves out, so now your revenue stops, but your expenses do not stop. So you have to make sure that your self-directed IRA has enough cash positions, cash reserves, to cover any type of expenses during the time frame when you may not have any revenue coming in. So you have to plan ahead for those type of things. You can never commingle personal funds. So if your IRA runs out of funds, you can't use personal funds to pay the bills. It's a prohibited transaction. There are ways to deal with that, and that's a different episode coming up on what we do when you run out of cash. The investment considerations are very important, and that's where you and your accountant can sit down, or financial advisor, and ask questions like, what should be inside my IRA? What kind of risks am I comfortable inside my IRA? What are the current tax implications, and what are the future tax implications based on the investments that I make inside my IRA? You've got traditional IRAs that are tax deferred. You have Roth IRAs that are tax free. Which one would be better for you? Which one should a particular asset be acquired in? And again, watch out for those prohibited transactions. Very, very careful. We also mentioned that the investment needs to be passive. So if you invest in something where it's an operating business, that's going to create a tax consequence. So for example, if you buy a membership interest in an LLC and the LLC is running a business, it's actually an operating business, you are going to be subject to unrelated business taxable income because it's an active business. And that's what they refer to as UBTI. So you're going to actually end up with a self-directed IRA that files a tax return called a 990T and potentially pays tax out of the IRA at the highest level. It's the trust tax rate. So it's very expensive. So you want to make sure that your attorney and your CPA review the investments to make sure it's not going to trigger UBTI. Or if it does, go through the calculations to see if that's a bad thing. Sometimes UBTI is not a big deal. You just need to be aware of it and file the tax return. But if you invest in something that is an active asset, an active company, it could very likely trigger UBTI, and that's where you have to watch out. Work with your financial advisor, your CPA, to actually file the 990T tax return. You can acquire real estate or other assets inside the self-directed IRA and get financing, or what they call leverage. So you can leverage an asset. For example, you could have your self-directed IRA buy a single family residential property as a rental property, and your IRA could put down 50% of the purchase price in cash from the IRA. And then the other 50% could be financed through a bank or something like that. There are some issues you have to worry about with leveraged assets inside of an IRA. Number one, the loan absolutely has to be non-recourse. The reason for that is if it's recourse, that means that the lender can go after you personally if there's a default on the loan, and that creates an automatic prohibited transaction because you've effectively guaranteed that debt because it's recourse. So it has to be a non-recourse loan signed off on, or as a borrower would be Exeter Trust Company as IRA Custodian, et cetera, et cetera. So it's very important that you realize that the IRA is the borrower. It does create some tax issues because now you have what they call UDFI, unrelated debt finance income. So going back to my example, you buy real estate, the IRA puts 50% down in cash and gets a loan for the other 50%. Because it's leveraged, 50% of the income, 50% of the taxable gain, et cetera, is considered taxable because it's leveraged with bank financing. So in that case, it has to be non-recourse. We've already discussed that and satisfied that requirement. But because you actually have leveraged the asset, now 50% of the revenue and capital gain in that example would be taxable as unrelated debt finance income, or UDFI, and you'd file a tax return, a 990T, to pay tax on that. So those are issues you want to be aware of. That's why most people, when they buy assets, especially real estate related assets in their self-directed IRA, pay all cash. They don't get financing involved. But it doesn't mean financing is a bad thing. You just have to be aware of the UDFI, meet with your tax and financial advisors and make sure you plan ahead. With that, when you're ready to go, you contact us. We'll walk you through this entire process and answer any questions you might have, and happy investing at that point in time. So with that, let's kind of discuss some of the general issues there. Again, we want to do a quick recap. You have to be careful that you understand what you're going to invest in. You have to choose the type of self-directed IRA you want. Then you have to choose the type of investment you want to make. Then you have to choose the IRA custodian that can support that particular investment. And then once you've gotten to that point, you're ready to get started. You're ready to transfer the IRA over. So you do an IRA to IRA transfer. And at that point, you're actually ready to start making your very first investment. And that's the exciting part, is the returns that you can get can be phenomenal on a tax deferred or tax-free basis. And it gets your IRA invested in something that you are comfortable with, not just the stock and bond and mutual fund market that maybe you're not comfortable with or don't completely understand. So with that, thank you so much for listening to Go Ahead Ask Podcast today. Our next episode is going to be unraveling the mystery of title holding trusts or land trusts. Are you ever in a position where you wish or you want to acquire title to real estate, but you don't want people to know that you are the one buying the property or that you are the one that owns the property? You can acquire title in a confidential and private manner through a title holding trust or land trust. So that'll be next on Go Ahead Ask. Again, we want to encourage questions and comments and topics. So please send questions and topics to ask@exetercode.com, or you can call us at area code 619-239-3091. If you have a general area of expertise and you'd like to appear on Go Ahead Ask, please give us a call. Let us know what that is. If you like our podcast, please share it, subscribe to it, like it, and share it with friends and family. We're on Facebook, YouTube, and all the other social media channels. Again, thank you so much. Have a happy new year. We'll see you soon.
Thank you for listening to Go Ahead Ask with the Exeter Group. Join us for our next episode when we further unravel the mysteries of real estate.